Markets keep hitting record highs, but don't be fooled. The US dollar is absolutely crumbling. Inflation is still creeping higher, and the Fed, well, they're keeping interest rates artificially suppressed. In this video, we're going to talk about the mechanics behind this bubble and why your money might be next. Let's start with the Fed's rate suppression mechanics. You see, the Federal Reserve has been buying Treasury debt, keeping yields artificially suppressed even as the underlying inflation remains elevated. This is classic financial repression. The US government has been forcing lower interest rates in order to reduce its borrowing costs. The problem here, it shifts inflation risks to you. And it also tilts asset prices much higher, which is what we've been seeing. You see, long-term sustained debt growth, well, if we take a look at 150% debt to GDP ratio by 2055, naturally, for example, it is going to push long-term yields higher unless they're actively suppressed. The result, well, cheap money will flood into stocks, bonds, and commodities, fueling this record-breaking rally. Now, if we take a look at the US dollar collapse and consider hyperinflation here, well, under Trump, pressure on the Fed to cut rates, add in tariffs, and the US dollar gets absolutely decimated, down over 10% year to date with a 50-year low. Now, Trump's administration has been, and we've talked about this before, very open in regards to dollar devaluation, hence the Mar-a-Lago Accord. Now, this will boost exports potentially. The combination, however, of a lower dollar, cheap money equals a hyperinflationary risk. You see, imports will absolutely start to surge, which we're seeing. Costs rise, but the Fed remains captive to the bond markets to suppress yields. Now, if we're taking a look at the fundamentals of economics here, we need two very important things. Number one, for a strong economy, we need a strong currency. You see, this preserves the consumer's purchasing power. It keeps import costs low. The second thing that we need are actually a higher interest rate, which will reflect real growth and inflation, and it would not be artificially suppressed. Instead, quite the opposite, it would support the dollar's strength. Now, today we have neither. We have a weak dollar and we have repressed rates, which distorts the information signals that drive investments, savings, and spending. Now, if we take a look at the money, at the market and economic disconnect, which is a big one here, we've talked about many times. You see, despite poor real GDP growth, sticky inflation, weak wage growth, and industrial stagnation, well, markets keep ripping higher. The disconnect comes from liquidity-driven pricing and not from economic fundamentals. In other words, cheap credit, not corporate earnings. Now, historically, this pattern matches pre-crash periods, and that includes if we take a look back at the 2000s when we saw the housing bubble, which was pretty well built on low rates. Now, if we take a look at long-term implications here and the risks, well, if the Fed breaks free and allows rates to reprice debt, well, yields are going to spike. Bonds, equities will absolutely collapse, not crash, collapse. And if Trump gains control of the Fed and pushes the rate cuts here, well, we can expect the dollar to be the one that crashes. We can anticipate surging inflation and further asset price froth, which means we're going to see higher prices for all these assets that you have. But for how long? You see, this era of debt financing growth is only possible as long as rates remain suppressed. The true structural reform would require a restoration of rate discipline and reducing deficits. We can also factor in gold here and a repricing of gold to the dollar, which could absolutely add some value. Now, this is all long overdue, but in reality, it is politically impossible. Now, if you're investing in 2025, you must understand what's going on under the hood of this market. You see, it's all liquidity-fueled bubbles, central bank capture, and currency decay. If you want the data and strategy and the charts, well, subscribe. Comment your thoughts down below, and let's ride this wave smartly. That's it for now, everybody. I'll see you at the opening bell.